About 5 years ago, Gravity Payments and its founder, CEO Dan Price, caused a bit of a stir in the employment space when he announced that he was going to be raising the floor of his company's salary, so the minimum wage that they would be paying individuals, up to 70,000. And previously it had been about 30,000, and this would mean that 120 of his workers, it looks like, were eligible for this pay bump. And the rationale behind the 70 grand number was that there had been studies that had come out at that time that indicated that 70 grand was kind of the floor where you stopped worrying about money, or the incremental increase in money at that point didn't equate to a massive jump in happiness. And so to accommodate raising the floor of his company up to 70,000, he took a pay cut off his $1 million a year salary. And at the time, I think a lot of us who work in the human capital space were wondering whether this was just a PR move, or whether this was just a gesture of appreciation, or if this really was a bit of a change, a sea change in the way people would be compensated. And so it's been a few years now since that move, and the CEO, Dan Price, he pops up once in a while in the media, and people, I guess, are curious about whether this tactic, this strategy to make sure that their company has a $70,000 a year minimum has worked, right? And so I was curious kind of to look over some of the articles that have been published recently, just to run over some of the numbers that they're reporting and what they're looking at in terms of success, and then just to discuss objectively, has it been a success? Has this tactic worked? And is it something that all companies should adopt going forward? So, just to recap, so the floor prior to making this move at the company was $35K a year, and then they raised it up to $70K a year. Again, Dan Price took it $1 million, or a hit to his $1 million a year salary, in kind of showing their gratitude to Dan. The staff pulled together and bought him a Tesla, which is something that gets publicized a lot. I guess it's a nice move on behalf of the employees. But again, kind of, is it PR? Is it a genuine gesture? Who knows? That's probably something for internal them to say. One of the things that Gravity Payments is reporting is that there's been a dramatic increase in first-time home ownership, having, or in the time since raising the minimum wage. There's been something like 70% of their employees have reported that they've been able to pay down debt. There's been a 10x boom in the number of babies born at the company. And so those three, I think, are interesting to just poke at a little bit in terms of success measures. We'll go into top line or revenue performance in a second, but for these three, so first-time home ownership, paying down debt, and the boom in babies, they're interesting because, well, when I hear about something like that happening over a period of 5-6 years, it's tough to really attribute that to raising the minimum. I'd say in terms of pay. I'm an advocate, of course, for that everybody should make as much money as they possibly can. Companies should pay as much as they possibly can, within reason that that their balance sheets can allow for. But first-time homeownership is one of those things that happens just as organizations age. I mean, I've seen lots of organizations that have young workforces, and then 2, 3, 4 years down the road, you start to see kind of everybody within a certain age bracket, they start to buy their first homes as they've accumulated a little bit of wealth over the years, and they've paid down a bit of student loan debt. They paid down their, whatever credit card or other kind of debts that they have. So, and that typically is just a function of having worked for many years. Granted, you need a level of financial security to be able to do that. So your salary does matter. And starting at 70 versus 35 definitely helps. But this is one that I think time has a big say. If you're going to draw out an equation, one of the big factors I think would be time. And so, that's one that I think is interesting to point at as a success metric. 70% of employees paid down debt. I think also that's a function of time. You don't have to, as long as you control your costs and you control your burn, you're able to pay down debt over time anyway. Again, it's a lot easier to start at 70 over 35, but I don't think that, there would be a dramatic change in the number of individuals who pay down debt as a function of the raise in the salary, because over time, hopefully, whether they had started at 35 or not, over time, the last 5-6 years with the company, hopefully they've got a structure in place where they're giving out regular, at least, inflation or cost of living bonuses each year, if performance-based bonuses as well, or performance-based promotions and increases in salaries. So that, I think, over time, hopefully people have a chance to make more money, and they would have got to somewhere close to 70 anyway, hopefully. And that would have also helped with paying down debt. And then the 10x boom in babies is another one, just like home ownership. I think, yes, the decision to have a child is a lot easier when you're financially secure, or a little bit more financially secure, but it's also a function of time. It's also a function of age. And as your workforce ages, they're going to have more kids. And so this is one that I think is difficult, again, to tie to the fact that the company raised their salary floor 5-6 years ago. And I say all this just to point to the fact that, when it comes to human capital and it comes to these kind of things, employer brands, those kind of things, yes, small tactics can definitely conjure good results. They definitely motivate certain outcomes. But a lot of the time, things like employee happiness, employee experience, candidate experience is driven by stuff that's a little bit more strategic and stuff that's a little bit more systemic than being able to say, okay, we're going to bump salaries up a little bit, and then that changes the entire game. And so it's really nice to see these results. And I think one of the reasons why the company, Dan Price, the CEO, is pointing to these kind of softer metrics is because it's hard, to say like this has probably had a massive impact on the way the organization works. Moving over to actual financial performance, it's reported that they've seen a 3x volume increase in payment processing since moving to this. So since jumping the salaries up to 70,000, and they had consistently increasing revenues up until the point of the COVID crisis, where I guess for some reason in a macro environment where everybody was spending money, their payments processing business was falling. So payments processing for small business, maybe that's a function of small businesses going out of business, and then therefore their payment processing volume falls. But so that's one that I'd be very interested to kind of dig into a little bit more. But the company had to go through a round of layoffs while they were faced with potential layoffs, and it's reported that the employees banded together to take pay cuts so that they wouldn't have to do the layoffs, which is nice. And I think maybe that's a truer look at the function of raising salaries, or at least the floor to 70, because then there is downside room if they need to lower salaries to keep everybody on board. So that might be a truer representation of what the power of raising everybody to $70,000 a year does. But so, and again, I bring up the financial performance to point to the fact that, yes, keeping your employees happy definitely has a great knock-on effect on the performance of your organization, but that doesn't always mean that it's financial. And oftentimes, just the press this was a huge story 5-6 years ago, and just because they got a lot of press could have been the reason why more businesses knew about them. Therefore, more people use the service, and therefore revenues goes up. So it's not always a direct correlation with the fact that they raise salaries. Now, the reason that we bring this up, and then the reason why I'm curious about what happened to this company is just to, again, point out that when it comes to human capital and when it comes to your employer brand, there are certain metrics like your time to hire, your cost per hire, certain indicators when it comes to employee experience, candidate experience, that are truer representations of what's going on at the employee level of an organization. Yes, it's nice to look at your financial performance. Yes, it's nice to look at soft measures like first-time home ownership or the number of babies being born. But it would be really interesting to look at this organization and say, okay, has there been any change in their cost per hire as a result, or has there been over the last 5 years, hopefully a decline in cost per hire or a declining time to hire because the place is a more attractive place to work, and therefore they're able to attract different kinds of workers as a function of this move. And so things like that are, I think, when you look at the employer brand objectively, those are more important and more salient, more tangible when it comes to the quality of this tactic from an employer brand lens. So what happened to Gravity Payments and their CEO, Dan Price, as a function of the $70,000 floor or minimum wage that they put in place? I think it's definitely been successful in some of the metrics that they're looking at internally, or at least that they're reporting out. But there are deeper things that I think, as an employer brand practitioner and as a marketer, I'd be curious to find out about going forward.